Hello, everyone, and welcome to the monthly market monitor for September. My name is Michael Ballman, investment analyst here at Corporate Central Credit Union. Before we get started, just a couple of things to note here. We are recording this webinar and we'll be sending out a link after the presentation. Everyone is muted, so if you do have any questions, please feel free to drop those in the chat or Q&A function at the bottom of your screen, and we'll go ahead and address those at the end of the webinar. And we'll go ahead now and get started. First, we'll take a look at some employment data, starting off with the unemployment rate. The unemployment rate for August decreased to 4.2% from a 4.3% level in July. Although we did see that decrease here this month, we did see a lot of increases here over the last several months as the unemployment rate continues to track up. Taking a look now at payrolls. So in August, the labor market added 142,000 non-farm payrolls, which was below the expectations of 165,000. That's depicted on the left side of your screen there. And again, we got the unemployment rate there on the right side. Also in July, we saw that those figures were revised down to 89,000 from the original 114,000 figure. This resulted in the June and July figures being revised down by a combined total of 86,000. Additionally, the ADP's National Employment Report showed that private payrolls added 99,000 in August. This was below the 145,000 estimate, as well as below the July figure of 122,000. Taking a look now at the U6 rate for August. As you can see here, that's continuing to track up over the past several months. We're up to now a level of 7.9% for August. This is the highest level now that we've seen since October of 2021. And then taking a look at the initial jobless claims for the week ending August 31st, we saw a decrease to 227,000 claims from the prior week's 232,000. But if you notice here, there's been some bouncing around with initial jobless claims, but overall very flat since the beginning of 2022. Taking a look at continuing jobless claims. Again, these have been bouncing around a little bit over the past couple of years. But overall, you'll notice there is a slight increase in this trend over time here. And for the week ending August 24th, we were at a level of 1.84 million continuing claims. This was down slightly from the 1.86 million that we saw in the prior week. And then taking a look at total job openings. So the total job openings number for July fell to a level of 7.67 million. This was from a downwardly revised 7.91 million that was seen in June. You can see that we've taken a big chunk out of the huge spike we saw as a result of COVID. This is now the lowest level that we've seen since January of 2021. And this was also below the market forecast that called for 8.1 million. You'll notice that, again, we are just about down to the highest level that we saw from the pre-pandemic levels on the left side of the screen there. Overall job openings decreased for healthcare and social assistance by 187,000. And then at the state and local government, excluding education, by 101,000. Transportation, warehousing, and utilities by 88,000. And then we saw increases in job openings for professional and business services by a level of 178,000. And then at the federal government level, we saw a 28,000 increase. Moving on from employment data, we'll take a look at retail sales here. We saw a 1% month over month increase in July after a downwardly revised 0.2% decline for the month of June. This came in well above market forecast, which called for a 0.3% increase. And this was also the largest increase that we saw since January of 2023. Breaking down some of the major sectors, we did see increases for motor vehicles and part dealers at a 3.6% level, electronics and appliance stores at 1.6%. Grocery stores were up by 1%, building material and garden equipment at 0.9%, health and personal care at 0.8%, furniture at a 0.5%, food services and drinking establishments at 0.3%, non-store retailers at 0.2%, and then gas stations at a 0.1% increase. We did see a few declines, specifically in miscellaneous stores, which dropped 2.5%, sporting goods, hobby, musical and instrument, and books, which was down 0.7%, and then clothing and footwear, which saw a 0.1% decrease. Taking a look now at the personal savings rate. So the personal savings rate, which is the share of disposable income for July, that came in at a level of 2.9%. This was down and continues to track down from 3.1% that we saw in June. It appeared that, though, the personal savings rate was starting to rebound a little bit after a turnaround in late 2022. But you'll notice here that we saw a peak in the spring of 2023 and declines ever since that time. It continues to be, harder for Americans to continue to save as prices are increasing, and it's just more expensive, as you're going out to the gas station, grocery stores, etc. And personal savings is really taking a toll as a result of this. This is now the lowest level that we've seen since June of 2022, where we saw the personal savings rate at a level of 2.7%. Next, we'll take a look at the housing market. So starting off with housing starts, for July, we saw a sharp drop off in this figure here. This came in at a seasonally adjusted annual rate of 1.24 million. This was 6.8% below the revised June estimate of 1.33 million and is 16% below the July 2023 rate of 1.47 million. Again, you can see large spikes and the beginning of 2024 and 2023. So again, that's why we're seeing such a large year-over-year decrease of 16%. Taking a look now at existing home sales. For July, we saw a little bit of a bounce back. This did come in at a seasonally adjusted annual rate of 3.95 million. This was an increase of about 1.3% from June after seeing 4 straight months of declines. So a little bit of a turnaround here as far as existing home sales go. On a year-over-year basis, existing home sales were down by 2.5%. And they also continue to remain well below pre-pandemic levels, as well as, the high volume that we saw during the pandemic, again, due to those low borrowing costs. Taking a little bit deeper dive into existing home sales, I took a look at the National Association of Realtors July 2024 summary. In there, it showed that for the month of July, the existing home sales price increased by 4.2% on a year-over-year basis, up to 422,600. And as you can see, this figure continues to track up over time as, again, those median prices are continuing to increase. Inventory of existing homes increased by 0.8% on a month-over-month basis to 1.33 million in July. And this is equivalent to about 4 months worth of supply at that current monthly sales pace. Breaking down existing home sales by region, you can see that the South, again, is leading the way there with almost half at 45% of existing home sales for July, This was followed by the Midwest with almost a quarter of existing home sales at 23%. These two regions continue to make up the lowest median home prices. I got the breakdown there on the bottom left-hand of your screen. So the median price in the Northeast increased by a level of 8.3% year over year in July, up to 505,100, followed by a 4.5% increase in the Midwest by 321,300. The West saw a 3.4% increase up to 629,500. And then finally, the South, which saw a 2.3% increase up to 372,500. So again, continuing to see those increases in the median prices on homes. Taking a look at a breakdown of existing home sales by price. No surprise there again that the 250 to 500,000 range is at 45%, the biggest chunk of existing home sales. Again, those are your typical, I don't say typical starter homes, but a lot of people being pushed into starter homes, I guess, within that range. Not many in that 100 to 250 or even the 0 to 100,000 range. Again, smaller pieces on this pie chart here. And then obviously, as we're moving into some of those higher priced homes, just not many people that weren't even able to afford those homes. So again, we're seeing less sales within those price ranges. Taking a look at the percentage change in sales on a year over year as grouped by the price range, you'll see that there were increases in all price ranges besides those bottom two tiers. The 100 to 250,000 range was almost the same level as a year ago, but we did see a large decline in the 0 to 100,000 range. The top three ranges had significant percentage increases year over year in respect to those categories. But if you recall from a few slides ago, we did see that existing home sales were overall down on a year over year basis, essentially translating to a larger quantity of declines in those bottom two ranges as compared to the increases that we're seeing in the top ranges. So I know 26.5% looks like a big figure on those $1 million plus homes. But again, that's just the percentage as it relates to that category compared to a year ago. Next, we'll take a look at the Institute for Supply Management's manufacturing PMI. This is just essentially looking at the overall manufacturing industry and the strength within that industry. So a reading of a 50 would indicate that manufacturing is generally expanding versus a reading of below 50 would indicate that manufacturing is generally declining. So the reading for August came in at 47.2, which was slightly up from July's 46.8 figure, but they did miss the expectations calling for 47.5. And again, we're still below that 50 level. So this did mark now the 21st monthly contraction in manufacturing over the past 22 months. Excuse me. So over the past 22 months, which now, if you look at that, that takes us all the way back to October of 2022. And again, that reading was just at 50. So even going back to September of 2022, before we were really seeing, that strength or that expansion within the manufacturing industry. March of this year was the only reading during that 22-month period above 50, and that was at a 50.3 level. Next, we'll take a look at some inflation data. So the inflation rate the inflation rate decreased for now the fifth straight month in August to a level of 2.5% from 2.9% seen in July. This was the lowest level since February of 2021 and below market forecasts of 2.6%. So again, continuing to see that inflation number drive down, which is, a good thing in the eyes of us. So the consumer price index, on the other hand, rose by 0.2% from July, which was in line with forecasts. And then the so-called Core inflation, which strips out food and energy, was at 3.2%, which was an over 3-year low for that core figure. The monthly core inflation increased to a level of 0.3%, or I'm sorry, increased by a level of 0.3% from 0.2% in the prior month and was above forecasts of a 0.2% increase. Inflation eased for food, which was down to now 2.1% from 2.2%, as depicted on the light blue bar in the top right half of your screen there. We also saw a easing in transportation, which came down to 7.9% versus 8.8% seen in July. Declines were seen in energy costs as depicted in the dark blue bar on the top right of your screen there. This decreased by a level of 4% versus 1.1% increase in July. Gasoline, which decreased by 10.3% versus a 2.2% decrease in July. Fuel oil decreased by a level of 12.1% versus a 0.3% decrease in July. Natural gas decreased by 0.1% versus 1.5% increase in July. And then finally, new vehicles saw a 1.2% decrease versus a 1% decrease seen in July. Inflation did increase for two categories, one being shelter, which increased to 5.2% versus a 5.1% level in July, and then apparel up to 0.3% versus 0.2% seen in July. So to recap some of that information we just went through, so the big stories here are, okay, inflation is continuing to cool, unemployment is trending up, we have a low personal savings rate, payrolls are declining, a continuing contraction in the manufacturing space, job openings, though, on the flip side, are continuing to fall, and then housing prices are continuing to increase. So I know a big hot topic right now is, well, okay, based on all the data that's out there in the market, what is the Fed looking to do at their meeting next week? So not to sit here and necessarily predict exactly what's going to happen, but just to give a little bit of insight as to what the Fed futures contracts are currently calculating, probabilities of the moves of the FOMC over the next few periods here. I did run this originally on Monday. I also ran it again today, and I'll show that in a few seconds here. But looking like now that 9/18 meeting, as of now, a full price is, or a full cut is priced into, happening at that meeting, with a slight chance, not a big chance, but a slight chance of a second cut at the 9/18 meeting. However, if we fast forward to today, you can see that now there's even less of a chance of a second rate cut at that 9/18 meeting, and then pushing all the way through through next year to 2025. Currently, as it stands, the Fed futures contracts are pricing in 10 total rate cuts by the end of next year. Again, not necessarily something to do as far as speculate what the Fed's going to do. I think we'd be more focused on making sure that our balance sheets are positioned not only for a potential for a down rate scenario, but also to have our balance sheets positioned for any rate scenario that we may encounter over, the life of our balance sheet here. Again, projecting to make long-term decisions on the investments that we're putting into our portfolios to help offset some of the other assets that we have on our balance sheet. But again, taking that real long-term strategy in our investments with our portfolio. Shifting gears, we'll take a look at some market rates. So I did pull these as of Monday. So on Monday, that green line there you can see versus the yellow line of the previous month. Anywhere from the belly to the long end of the curve, we were seeing about 18 to about 37 basis points of decrease, depending on what tenure you're looking at. The 1 month was down by about 19 basis points. And then jumping to the year over year look, again, Monday being that green line there, and then the prior year in yellow. The short end and long end of the curve have not dropped as significantly as the belly of the curve, as you can see there. The 1 year did have the largest decline of about 120 basis points year over year. Next, we'll take a look at some market rates. Again, all of these pulled as of Monday. Looking at the 2 year Treasury, that was at a level of 3.68. And then taking a look at the 10-year Treasury at a level of 3.73. I don't know if anyone has noticed there, but we no longer have a 2 to 10-year inversion on the yield curve. So just something I was going to point out there. Taking a look at the overnight SOFR, that's been hovering around 534, give or take a few basis points, again, since the Fed had paused their hiking cycle. Taking a look at 1 month LIBOR, again, this is not being used anymore, but is still published using a synthetic methodology. You can see as of recently, that's been tracking down now to a level of 522. And as far as I know, this synthetic methodology is still set to expire at the end of the month. So chances are we're not going to be seeing this in any of our future presentations. Taking a look at the 3 month LIBOR, again, using that synthetic methodology, coming in at a level of 5.19. And again, tracking down recently in anticipations of some rate cuts. Taking a look at the interest on excess reserves, similar to SOFR, that has been flat at 540 ever since the Fed paused its rate hike cycle at the second half of 2023. The 30-year Fannie Mae commitment rate has been trending up as of recently throughout 2024 after the major dip that we saw in the fourth quarter of 2023. Recently seeing again a bounce back up to now a level of 658. And then finally, the MBA refinance index, which has remained low, but tracking up recently. It's still well below levels not only seen during the low rate environment from a few years ago, but also dating back to pre-pandemic levels, as again, high borrowing costs continue to de-incentivize borrowers from refinancing. All right, so that is everything I have for you today. I'll go ahead and check the Q&A and chat functions here to see if there are any questions that came through. I do have my contact information on the screen as well as the contact information for the investments department. If there's anything that we can do to help out in any way, please let us know. We'll be happy to assist in any way that we can. Okay, looking at the chat, I don't see anything within the chat. I don't see the Q&A. I don't know if anyone else can see if there's anything within the Q&A function. Otherwise, if there was something that you dropped in there and you want to send that to me via email, I'd be happy to assist with that question. So again, thanks everyone for your time today and have a great rest of the month.